numbers, how you use them.
T-minus 3, 2, 1, 0, and liftoff.
Hello, and it's April 1st, and there's no April Fool joke here. We are just going to dive into it here in 2024, and we are ready to talk and ready to walk through some stats and stuff. So today we're going to walk through a couple things. First of all, a couple of you sent in requests. You made some comments and everything about Fed rates. You want to know about Fed rates, and you also wanted to know about, how that affects interest rates, and our mortgage is going to come down. So I said, you know what we'll do? We'll dive into a little bit about the Fed, and we'll talk about Fed rates and a history, and then let's do a little case study on mortgages, along with a little bit of a forecast for this year and what we think it's going to be. And a lot of you said yes. So we're into numbers. When we talk about the U.S. economy and we talk about rates, it only means one thing. The crew and I are doing tequila shots before the show. That's exactly right, because who can figure out our government or our Fed or our interest rates? And we have discovered what is the best tequila to mix with the vault. And I got the black cherry vault right here. Unlock your brain. Yummy. And we found out it's not gin. It's not vodka, it's tequila. If you're gonna mix tequila with vodka. And George, what was the best tequila we figured out worked best?
Añejo, Tom, añejo.
Añejo, that's exactly right. Añejo Gold. So if you're gonna be doing that and you're gonna both unlock your brain and unlock your inhibitions, there's your combo. So let's dive in. So the St. Louis Fed, we're talking about the St. Louis Fed. The St. Louis Fed is a great source of numbers. And if you take the time to go there, you don't really have to, but every now and then you may see an article in the paper or someplace that talks about the St. Louis Fed, and that's usually a source of numbers. And what was interesting is to go to look at the history of rate hikes in America to see just how steep the 2022 rate hike was in response to the inflation that followed the printing of money, trillions of dollars printed, which followed the COVID 30-month, COVID where we all shut down. So about 2 years of COVID and everything that went along with that, then printed a bunch of money, inflation went amok, and we started raising rates. So here is a chart here, the first chart from the St. Louis Fed, and it shows you how many months since a hike cycle began. And we can all see that with a couple of exceptions, you're going to see on the chart here. And for those of you that are listening on Spotify, let me narrate this a little bit. So in 1999 to 2000, there was a quick recession, but it was pretty intense. And some people called that the nuclear winter because it was like fast, but it was intense. And so you can see that it only took about 12 months to raise the total Fed rate 2%. Now that usually happens a half or a quarter or percent at a time. So 0.5%. 1%, 1.5%, 2%, that would be 4 rate hikes over a year. That would be pretty dramatic. I mean, you can see there, 1999 only took about 12 months to do that. Then we had the 04 to 06 rate hike that happened right before, remember 2008 was the big financial crisis. So you can see that over a 24-month period, they raised rates 4 percentage points. So that's the Fed. So you see that's a steady climb. That's like 1% a year for 1% and a quarter a year for 3 years, a very steady green line there. But now if you want to go take a look at the rate hike that happened from 2015 to 2018, so that's the 3 years of gentle rate hikes that happened before COVID happened, end of 19, we all learned what the Wuhan lab was. Beginning of 2020, oh my God! We canceled hockey, we canceled March Madness, we canceled, the NBA season, everything. But anyway, you see the blue line is very gradual. It only raised rates 2% over 36 months. So it was a very gradual rate hike. Then you see the last line. And it's almost like watching, bamboo grow. Bamboo grows very fast. It is a straight up line over 12 months, and it was a 5-point rate hike. Now remember, inflation was 8, 9, 10, 11%, depending on who you believe, and the government was talking about some of that. So remember, you don't believe the government if their lips are moving. That's a simple rule of thumb. But you can see what happened there, 5 percentage rates up from 2022-23. So you can see that the 2022, that year of rate hikes, has been the most dramatic, 3 times as fast as 2015 to 18, 2 times as fast as 2004 to 2006, 3 times, and then twice as fast as 1999 to 2000, but it was 5 percentage points, whereas 15 to 18 was only 2 percentage points. 4 to 6 was only 4 percentage points, and 1999 to 2000 was 2 percentage points. And so you can see how dramatic that was. And so the lesson here is that we are living in unprecedented times. So everybody's waiting for the rates to drop just as fast, and it's just not going to happen. And so if you're listening, it's time for a longer term 5-year view, and that's what I'm going to do when we do the case study on mortgages when I go to the board in just a few minutes. But first, the question is, well, we're hearing that maybe some's going to do it down a little bit here at BizDoc. So what is that? Take a look at this calendar. This next chart is the calendar of the Fed. And so the Fed met January 30th to 31st. They did a press conference. They said, hey, not going to be lowering rates 4 times this year. We don't think so. They meet about every 6-7 weeks. Then they came back on March 19th and 20th, and they said probably only 3 rate drops. The next time they're going to be meeting is April 30th, May 1st, and then June 11th and 12th, and July 30th and 31st. So think about this. April 30th to May 1st is around the corner, and we do not think we're going to get a rate cut because remember, that's in 4 weeks from now. It's April Fool's right now, 28 days, 29th, bang, next 2 days after that. So we are 4 weeks and 2 days from the meeting. Now, if you're listening to this in the future, the same rules apply. You may be listening to this in 2025, 2026, but the Fed meets every 6-7 weeks, and you can look at it and see, well, the Fed is a big indicator of what's going to happen to mortgages, and so you can kind of, gauge yourself. But we do not think here in 24 that we're going to get a rate cut on April 30th, May 1st. We do think we're going to get a 0.25 rate cut on June 11th and 12th, nothing on July 30th and 31st, and then a 1/4 point on September 17th and 18th, and then maybe another 1/4 point November 6th and 7th. Why? The Fed wants to see inflation down to 2%. It doesn't want to see a lot of layoffs. It doesn't want to see a lot of economic uncertainty. And then there's the 3 rate cuts that we get, which would be 0.75, 0.75% this year, which would only take the rates down, the federal rates. Remember, that's the rate that the banks borrow from the federal government. Only would take that rate down to like 4 3/4 or something like that. Maybe 4.5. But that's it. So people ask the question about, when rates go up so fast, do they come down so fast? So the answer to the question that I got in the comments is no, they usually don't. They usually come down gradually, unless there's like a major market crash or a COVID recession or something crazy, and they drop the rates low to give businesses the option of borrowing money super cheap to keep jobs in the economy. But if there's not some radical bad news, then rates go down. So the only way you benefit is if you've got money in the bank and the economy burps and your money is not affected, and now the rates go down, housing prices go down, you can take advantage of the situation. Most people are not in that situation. So that's the story of rates, and that's the way it works, and I hope that's helpful to you. Now what we want to do is do a case study on the mortgage rate itself. Now we've talked a little bit about the Fed. Now let's go talk about mortgage rates. So I'm going to grab my vault, unlock your brain, and let's go see if I can unlock the door to Studio B, go find my board, and do a case study on mortgages. All right. I found my board. I found Studio B. There's nothing better than a big drink of ice cold Vault. Blackberry, watermelon, cucumber, mint. Go to Amazon right now and get your favorite and see if it doesn't unlock your brain. No sugar, no caffeine, just a lot of pop. All right, here's what we talked about. We just did a little quick look at the Fed and the Fed rising rates. But is that the whole story of mortgages? And what does it mean for you and me? How do we plan our lives? Well, let's go talk about it. So I figured I would dive into a quick case study of interest rates, specifically mortgage rates, and talk about what's behind the curtain and how it all affects. And I'm hoping that this is going to help you. For some of you, this may be real simple. For some of you, this may be real helpful. But I hope for all of us, it's illuminating. We're sitting here April 1st, no April Fool's jokes here. You know, I'm not having Adam do, the Biz Doc case study or anything like that, or any April Fool's joke. We're diving into something that is not funny, and that is usually the cost of housing. We all want to be able to live in an economical cost of housing that we can afford, have housing we like with a little bit of lifestyle, so we can save money for ourselves, our family, what we want to do. And frequently that's made more difficult by the cost of housing, which is driven by interest rates. Whether you're paying the interest rate as a homeowner or you're renting from someone, and that interest rate is sort of baked into your rent. So let's begin. So the story. We're going to dive into headlines, and I'm going to show you some of the headlines you may be seeing, and some of you, these may be the very headlines that you asked about in the comments, because I'm doing this in response to you. And then we're going to talk about historical mortgage rates. What has it been historically? Is it going to go back down? What is the norm? What has been typical? Are we living in typical? Are we living in high? Are we living in low? Where are we? Then we're going to go down, okay, so now we know what the history is. Why do rates go up and down? And are they going to be going down for me shortly at the time I live? Because we've all chosen to live here in the present. Okay, headlines. This is just last week, March 27, 2004. Mortgage rates rise, dip, still above 7%. So in other words, there's a lot of uncertainty in there. Rise, dip, make up your mind. Then, weekly mortgage demand drops, meaning people like you and me are not putting in applications for mortgages. That means the demand for mortgages drops as interest rates rise again. Why? We don't want to have a higher payment. So we say, hey, honey, we're not going to put in our mortgage application this week. Maybe we'll wait. But the Fed announcement will be key for spring market. So we're all waiting for the Fed. Are they going to drop rates, stable? So there's a lot of moving parts right in that headline, right? Then national mortgage news. All they care about is mortgages. Weekly purchase applications down 15% from last year. Mortgage demand drops. How far? 15% year over year. And if you're running a business, 15% year over year sucks when it's going down. And then mortgage rates to stay elevated on inflation worries. Now we're worried about inflation and mortgage rates coming high, mortgage rate rise. So there's a lot going on in here, right? Take a look at this. Consumer demand, inflation, boom, boom, boom. How does it all feed into the total picture? Let's dive in. All right. First, let's look at a 5-year history. The headlines certainly look gloomy. None of those headlines was positive. Every one of those headlines was kind of a negative story. Headlines do tend to be negative unless the stock is going to the moon. NVIDIA up again, but that's rare. Normally the headlines is something is wrong. So over the 5-year history going back to 2018, here is a chart. And what this chart shows is that going back to 2018, mortgages were between 4 and 5%. 2019, they dropped under 4%, where they would stay until 2022 when, what happened? Inflation went bonkers as we were recovering from COVID, which started in 2020. Remember, it was January, February 2020, where they locked us indoors and all these things happened. Remember the NBA game, Mark Cuban standing up, boom, boom, boom. That was the trigger. Mark Cuban wasn't the trigger. He triggers a lot of things nowadays, but that wasn't it. But that was him responding. But that was the whole thing. It all came crashing down February timeframe of 2020. We knew what Wuhan meant, and we were on the COVID slide to the bottom, and it sucked for 2 years. But then 2022, inflation went bonkers. And inflation went bonkers, and you can see the line suddenly goes dramatically up 2022 after sitting below 3%. Now it's all the way up peaking above 7 and hanging between 6 and 7 ever since. That, the 30-year fixed mortgage rate. So if you're listening on Spotify, I just described, and I hope you followed that, how we were basically under 5% or mostly under 4% for 5 years. So in this green box on the left side of the graph, we're showing we spent 5 years with mortgages averaging under 4%, a little bit of a peak above 4.5% to 5% in 2018 and 19 before COVID, but the whole rest of the time we were well under 4%. And we have spent the last 2 years well above 6%, always above 6%. And right now, we're hovering right now on 7 to 7.375, which is 7.38. We're sitting here on April 1st. Depending on your credit, that's about the mortgage you're going to get right now. So we're above 7. And if you're really lucky, you can get 6.9 or something for super credit and a big down payment. But you can see, so chart shows 5 years under 4%, last 2 years above 6%. Wow, that's a big difference. Now, people think 4% doesn't sound like much more than 6%, BizDoc. Does it? Well, think about it. It's actually 50% more. So 4% times 50% would be 2. So 2 and 4 is 6. So that's 50% higher mortgage rates. Let's take a look what it would do to a real mortgage. So I said they're right around 7% now. So let's compare 4.0% to 7%. Well, first of all, here's a little chart showing a simple mortgage. A home price of $450,000, a mortgage that is 80% of that, so 20% down, and a 4% interest rate means $1,719. So call it $1,700, and the banks probably are going to require you to have $58,000 to $60,000 to qualify for that. So in other words, you need to be making right around $60,000 a year to qualify for a $1,700 mortgage, which is at 4% on a $450,000 house. Follow that? Well, look at what happens when the rate goes to 7%. The payment goes from $1,700 to $2,400. That's another $700. That's more than a car payment. And guess what? That would take $82,000 to qualify for the same $450,000 house. So 4% to 7%. At 4%, you only need $58,000, $60,000 to qualify. At 7%, you need a touch over $80,000 to qualify. Well, why? Why is it, basically a 33% increase in income for a 50% increase in the interest rate? You follow that? That's the difference. And that's why the housing market slowed down, because people suddenly looking at the same house with rates going up rapidly, they couldn't afford the payment on the same house they were looking at just 2 months ago. So what could they afford? Well, let's go to another chart. On this chart, we show there's the $1,700 payment for the $450,000 house with a 4% interest rate. Now watch. Interest rates go to 7%, and the bank says you can only qualify for a loan on a house that costs $325,000. Well, wait, why is that? Well, because a $325,000 house for 7% is the same $1,700. So in other words, if you could only afford, with a $60,000 income, a $1,700 payment, at 4% you can buy a house that's $450,000, but at 7% you can only buy a house at $325,000, the price. See that? That is why home buying came to a screeching halt when all this happened. Remember, it stopped. And home prices went up, which was weird. But the reason the prices went up is because people had those low mortgages at 3%, and they didn't want to get rid of them. So people have kept their houses, and they're not putting houses on the market, so there were fewer houses on the market. A lot of things happened there. So the whole housing market came to a halt. But we're going to limit this to interest rates and its impact. So you can see from 4% in January of 2022 to 7% in January 2024, What happened to your buying power? You could afford a smaller house on the same income, or a lower priced house. Now then, why did those rates go up? Well, there's a lot of reasons. It's not just the Fed, but that's most of it. This chart shows what the Fed interest rate was in January of 2018. It was hovering around 2%. Wait a minute, Tom. I thought you said mortgages were 4%. That's right. Banks have to make a profit. So if you were selling apples and you bought a bag of apples from a farmer for $3, you'd probably want to sell that for $4 to somebody. Make sense? And you'd make $1 on the bag of apples. That's your profit. Well, guess what? There's a profit that the banks need to make when they borrow the money, say at 2%, and they loan it to you and me at 4%. The difference is their profit. In simple terms, I'm highly simplifying it, but that's basically the way it works. And you can see on this chart, the rate was right around 2% from 2018, 2020. During COVID, we hyper-reacted and dropped it to near zero because we were scared. The economy was in trouble. We wanted to keep jobs, so we dropped the federal rate to near zero to help companies be able to borrow money to go keep people employed. That's what the thinking was, among other things. And then you can see 2022, we came out of COVID. We had printed all that money for those stimulus checks. That money didn't grow on trees. The government just printed it. And when I say printed, it was digitally issued. We don't really print anymore. But away it went, and that put all that extra money in the economy, which inflated the price of assets like houses. And at the same time, they raised the interest rate to combat inflation, and you can see the line streaking up to the top to over 5%, where it is today, 5.25. So you can see over time what the Fed did to the cost of money. Well, that's one part of it. But the mortgage rates follow several things. Key drivers. First, they follow the Federal Reserve rate, which we just looked at, which is now over 5%, because that's the borrowing cost for the banks, because the Federal Reserve rate determines the prime rate. The prime rate is what it costs banks to borrow money that they give to us on credit cards, on mortgages, etc. The other thing that affects the interest rate is inflation. Inflation affects buyers' ability to qualify for mortgages and to afford payments. The economy itself, unemployment. If unemployment is rising, well, that raises the risk to the bank that they give you a mortgage and then you lose your job and you can't pay it. So that's a risk. So the economy and everything that goes around that, that's part of the up and down of mortgage rates. Then the loan market. If there's more buyers trying to get mortgages, the banks have to compete with each other. Oh, I'll give you one for 5.25. I'll give it for 5.5. They compete with each other within a small window, as long as you're a good customer. So that keeps interest rates kind of under wraps, kind of down a little bit, the loan market. And finally, the bond market. Well, let me explain this for a second. We're going to take a minute here. The bond market. Mortgages, when they're all done and you've bought a house, you're in there happily, getting new carpet and painting and doing all those things, that mortgage will probably be sold in that year to be packaged into a bucket of mortgages that are put into a mortgage bond. And the mortgage bond represents debt, because all those mortgages are debt from people like you and me that got the mortgage on a house. And then investors come and buy that because they make money on that. How? The interest we're paying on the mortgage is their revenue, and they hope to make a profit on that. So, excuse me, all those mortgages are packaged into bonds. And now then, who buys those? Investors. Investors buy those bonds. But it's called debt, right? Because all that mortgage is debt. They also look at corporate debt, and they look at U.S. government debt, which is called a treasury bond or a T-bill. So now they're comparing, what can I make by putting $1 million into a mortgage bond, buying it? What can I make making $1 million put into a treasury bill, or corporate bonds? So that's the debt market, and the debt is competing with each other. And mortgages, they want to say, hey, these are really good mortgages. You can make more interest than you can make on the Treasury. There's competition for the investors that are buying that. Make sense? So that also feeds in. All these things feed into the actual rate that the bank puts on it. And one of the big things, as I just mentioned, the Treasury bond. Treasury bills or U.S. government debt is deemed to be nearly risk-free. Why? If the government suddenly decides to default on all of its debt, we're all screwed. So it's like, that's a major thing. That hasn't happened, but that's why they call it near debt-free. They say, yeah, the government's going to print money, they'll pay it off, they'll figure it out. And so that's why they call T-bills debt-free. So if you wanted to buy debt, you could buy U.S. government debt, nearly risk-free, or you could buy mortgages. But you want to know that they're good mortgages, that they're good people. And if you've ever seen the movie The Big Short, where he plays Jenga and he builds that Jenga in that guy's office, double A's, single A, triple B. Well, guess what? Triple A's were the best. Double A's were next, and then triple B and double B. And then you found out that in that particular mortgage bond he was describing, there was a bunch of very terrible loans, but they convinced the buyers that they were all AAA. Bingo, there's The Big Short and all that goes in it. Well, nowadays it's much more carefully done, you hope, you think, at least they say. And investors want to come buy AAAs, but they compare it to treasuries. Make sense? Well, the difference between the treasury yield and the mortgage bonds is called the spread. And it's the 30-year mortgage spread they look at. So we're going to take a look at this chart. The gray area on the chart is where the 10-year treasury is. So near risk-free debt. And then the 30-year mortgage, which you hope nowadays is far less risk than 2008 and 2009 during the time of The Big Short, as was described in the movie, portrayed, based on a true story. And so you see here that the yellow line, which represents the mortgage rate, and the blue underneath represents the treasury. And typically, historically, they're only about 1.7 points apart, meaning you could make more money on a mortgage than you could on a treasury. So if you took $1 million, put it in, you'd make more buying debt on mortgages than you would buying a T-bill from the U.S. government. And so that's why when everybody looks at it, they always say, and now that I've mentioned it to you, you may see it, you hear them saying, well, mortgages right now are getting closer to the 10-year. When they say the 10-year, they mean the treasury. So whenever you see that, that means that the mortgage rates are probably getting more competitive. So you can see there are quite a bit of ways there as we're here in July 23, January 24. Let's go take a look at what the historical spread should be. All right. From 2005 to 2019, 14 years, mortgages were only 1.72% above the 10-year treasury. So in normal times, with good mortgages, good people, and a good economy, maybe going up a bit, down a bit, but generally a stable economy, you should see only about a 1.7% spread between the 10-year treasury and mortgage rates, the rate you and I pay. In 2019 to 2022, after those 15 years, what happened? COVID crushed the economy, and the Fed dramatically raised rates in 2022 to fight inflation after dropping them dramatically during COVID. So it was this up and down thing. Then in 2023, we're waiting, are rates going to get cut? We still have inflation we're fighting throughout 2023. Those were market uncertainties. And the spread, instead of 1.72 between the Treasury and the 30-year mortgage rate, was 4.89, almost 5%. Why? Because it was really uncertain. And to get investors to buy mortgage bonds, which makes the whole world go around in mortgages, they had to offer them almost 5 points of profit to get them to buy it. Then in 2024, the uncertainty is less, rate cuts are anticipated, the spread has come back to 2.9, still higher than 1.72. Now let's look at what this means for you and me, and I hope I've given you an education on the kind of things you might be listening to just on the business news to kind of anticipate where mortgages are going to be going as you plan your life on buying a home, refining a home, or staying put and renting if you're in a particularly hot market. So here we are, the 10-year Treasury and the 30-year mortgage. I've made a little chart for you. In the first row, you have the 10-year Treasury. October of last year, it was 4.89%. Q1 of this year, 2024, was 4.14%. Okay, that's the Treasury. The spread at the end of last year was almost 3%, 2.9. So you take the Treasury, 2.89, plus the spread, 2.9, bingo. 30-year mortgage at the end of last year, 7.79, just under 8%. Nobody wanted that. Very few mortgages were getting written, and you can see why, because it's expensive payment. Now, Q1 of this year, if you take the 10-year Treasury at 4.14, the spread is only 2.46, and the 30-year is now 6.6, or down a full point from October. So from 7.79 to 6.6. And I just told you that right now, the rates are almost exactly 7%. So as we go into April, the end of Q1, we're right around 7%. So the 6.6 here to 7, bingo, there's the range. Now, what would the interest rates be today if it was a spread of only 1.7, which is what it was for 15 years from 2005 to 2019? Well, let's take the 4.14 for the 10-year Treasury plus 1.72 spread, it would be 5.86. And by the way, if you look at history, a 5% mortgage historically is a pretty solid mortgage. We lived in unusual times with those 2.5% mortgages, very unusual times. If the spread was back down, we'd be sitting there at a 5.86% mortgage right now versus a 7%. So it's about 1.2 apart. Okay, so why is that so large today, Tom? I thought inflation was coming down. I thought maybe they were going to cut rates. I thought the economy had calmed down. I thought 2024, the stock market was doing okay. All right, those are all good questions. Questions I'd be asking. Well, first, there are risks to investors who hold mortgages. And right now, there's what they call prepayment risk. Let's say you had gotten one of those 7.75% mortgages last October. As soon as the interest rates go down, what are you going to do? That's right. You're going to pick up the phone and call the same mortgage broker that helped you buy the house. You say, hey, rates are at 6. I've got a 7.75. Is it time to refi? And he would say, yes. And so you would refi like right at 6. So guess what happens to the people that bought the bond that had that mortgage in it? They lose their income because you just refied it. Make sense? So the bank or the mortgage bond that had your mortgage in it, they lose. You just eliminate it because you paid it off and got a new mortgage at a lower rate. You refied. So the interest rate stays higher on the mortgages so they can make a higher profit on the mortgage, anticipating that you're going to be refining in 2 years. Make sense? So that keeps the spread high so they can make profit between now and when they think you're going to refi. And what the Fed was saying, hey, we're going to drop rates 4 times in 2024. That was good news for you and me. That was good news for companies that were going to be getting debt to buy factories and equipment. But for the people that had invested and bought your mortgage at 7.5, that's bad news. They're like, crap, they're going to refi it and I'm going to lose the profit I was making. Point 1, that's called prepayment risk. Second, low demand. There were less demand for mortgage debt in the debt market, so they need to keep the spread higher. You would say, wait a minute, Tom, I thought if there's low demand, prices come down. Yes, except they're not worried about the demand for you getting a mortgage. They're worried about the demand for people that are going to buy on the debt market the mortgage bond that has all the mortgages in them. So they need to keep the spread higher so that there's more of a profit versus the treasury or the corporate bond. So they say, you know what? If all of those are good customers, I'm going to buy that thing at 7% rather than just getting 4.9% from the treasury. See, the game is make money when you invest money. So they're going to go with the spread. So the spread stays high when there's low demand for mortgage debt investors. That's a problem. So when will the spread shrink? Well, first of all, if the Fed cuts rates 0.75% this year, 3 cuts of 0.25 starting in mid-June, as we speculate, then you will see moderation. You'll see maybe for 3/4 of a point cut, you might see a 0.5 point or 0.375 in the rate. Then a stable economy helps. Inflation down, unemployment down. Remember, unemployment represents a risk, because if you lose your job, then you don't pay, your mortgage. That's a risk. If unemployment is low, then we can assume if we give good people mortgages, there's not the risk of them losing a job and not being able to pay for it. Finally, the GDP, our economy, growing, all of that helps to ease mortgage interest rates over time. It will ease them. On the other hand, what drops interest rates rapidly would be mayhem, like a recession. And if you're one of the few that has a bunch of money in the bank, and that could be your down payment, and you can have a stable job, when a recession happens, you can pounce. That's not usually what happens. If a recession and inflation happens, you're usually less able to afford housing today than yesterday because of inflation, and problems have happened. So while a recession can make it look good, frequently a lot of people, like the ones that are laid off or the ones impacted by inflation and the price of heating oil and gasoline and all other things, boom, goes the other way. And during a recession, people usually, their debt goes up because they're using credit cards. That's why we have over $1 trillion in credit card debt right now. So that's when the spread can shrink in those cases. Now then, so what's your next move? Glad you asked. And that's what many of you were saying. Can you break this down for me so I could just generally understand? Now, there's a lot of technical things. There's probably going to be a lot of mortgage experts that write long answers in the feedback in the comment section. I encourage you to do so. I'm trying to paint the picture as broadly as I can so a typical person can understand, what do I do? Well, first, buy and refi. If you're feeling good that the rates are going to be down after the election, and maybe you're in a market where prices are cooling, San Diego and Austin, prices for houses are dropping. Austin is down 20% from the peak. So they had this big peak, and now it's come back to reality. Okay, that's good news. So now you could buy and refi in 2025. So if you bought now on a 7% mortgage, and the estimates are true that it'll be like 5 3/4 by the end of this year, maybe in early 25, 5 1/2. That's a 1.5 refi. That's meaningful. You could buy and refi, but I would only be buying in a market where I felt good about demand for housing being there, because if it suddenly drops like San Diego and Austin, that's bad. Now you've bought an expensive home, you could refi it, but you're still stuck paying the price, paying off over time the price you paid for that house. Second, watch and wait. What's watch and wait? Well, 5.75 at the end of this year on the 30-year mortgage is possible. That's about 1% or more of what you have today. Maybe you watch your market and wait for opportunities at the end of this year. See what the election does. That's the watch and wait strategy, to see maybe if prices stop going up so much, or maybe they ease in your market. But the lower interest rate on the mortgage is going to make it more affordable for you in that market. And the other way, hold. Rents are at a historical beneficial point versus mortgages in many markets. Like here in South Florida, in certain places in California, rents are better than mortgages. Let me explain. If you went out and bought a house or a townhouse or a condo, and you're paying for the house, then you're paying for the insurance, and then you pay the property tax once a year. Add all that up, divide by 12. What is your really total all-in cost per month? Compare that to rent. If your all-in cost is $3,500, but the rent is $2,750, guess what? You're in a better place to rent than buy, and most of your first 3 years when you buy a house, first 5 years actually, on a 30-year is interest. So you're better off waiting to build up a bigger down payment and wait for situations where the math works out. Make sense? So you look at your rent as the $2,700 as be interest anyway. Now people say, well, what if the prices keep going up? Well, they don't. Certain markets retreat, like we're seeing today in San Diego and in Austin and other markets. Those are just two that I know are in the headlines that you could search for those online right now and see what I'm talking about. So buy and refi in 25, watch and wait, or hold. That's what I think the options are right now. But the number one thing to do, get smart. Learn how this works. Be ready. Be knowledgeable. Don't get taken into a bad type of mortgage. Be ready. Know what you're getting into. And above all, be able to save even after you get the mortgage. You want to be able to pay your mortgage, set aside for your property tax, cover your basic maintenance and stuff, and still be able to save for the future. That is putting yourself into a great financial position. I hope this is what you wanted in terms of people that wanted a quick story about it. I'm sure there's more technical answers people could participate in the comments and offer, but I hope I've given you a framework to understand mortgages, understand 2024, and what your options are. I hope I've unlocked your brain just like a vault. Now I'm going to go back to the main studio and wrap up. All right. I hope that was helpful to you. I hope you enjoyed that. I enjoyed putting that together because mortgages, interest rates, how it affects us, how it even affects rent, I think is important to all of us as we plan our lives and try to live faithfully and fiscally sound, making good decisions for ourselves that don't stretch ourselves and put ourselves in the best position to save money for what we want to spend it on, rather getting forced into expensive housing. And if you like that case study, and I hope you did, here's a couple case studies from the Biz Doc archive that I hope would also, like a vault, unlock your brain. Until next time, I'm Tom Ells with the Biz Doc, and I hope I left you better than I found you.